As the U.S. markets are closed for the weekend, we are looking at the final print for Nuburu Inc. from the end of the session on Friday, November 14, 2025. The stock, ticker BURU, finished the day at $0.25 per share. That was a decline of 2.77%, a loss of just under 1 cent. Now, seeing a 2.77% fluctuation on a 25-cent stock might seem like statistical noise to most. It's the kind of volatility that many traders using the Robinhood app or the SoFi platform might just scroll past, looking for bigger movers. But this is where expectation and reality begin to separate violently. The expectation, the only thin narrative keeping this stock listed on the NYSE American, is a story about breakthrough blue laser technology. The reality, however, is buried in the anemic trading volume and the crushing weight of that 25-cent price tag. This price isn't a bargain, it's a warning flare. The story of Nuburu isn't about its potential to be the next NVIDIA stock in the hardware space. It's a desperate story about corporate survival. The question isn't if it will grow, but if it will exist this time next year. The common belief, the pitch that was sold to investors when Nuburu came public via a SPAC merger, was compelling. It's a great story. The company produces high-power industrial-grade blue lasers. The core sales pitch was that these lasers are uniquely, brilliantly effective at welding copper. Why does that matter? Electric vehicles, battery manufacturing, grid-scale energy storage. The entire green energy transition runs on copper. The problem is that copper is highly reflective to infrared lasers, the current industry standard, making welding it difficult, slow, and messy. Nuburu's blue lasers, however, are absorbed almost perfectly by copper. This was supposed to be the picks and shovels play for the entire EV boom. Investors who watched the stratospheric rise of Tesla stock were hungry for the next big supplier. This expectation that specialized high-margin hardware would win the day drove the initial hopeful interest. People setting up their first individual brokerage account, perhaps at Fidelity or using a service like Schwab Intelligent Portfolios, might have been tempted to throw a small speculative bet on BURU, dreaming of a 100x return. But that expectation has collided head-on with a brutal, unforgiving reality, and that reality is the balance sheet. A 25-cent stock is in critical condition. Period. The real story driving this stock price isn't the total addressable market for copper welding in 2030. The real story is the immediate, looming threat of delisting from the exchange, and more fundamentally, the threat of insolvency. When a stock trades below $1 for an extended period of time, the exchanges send deficiency notices. Nuburu has been living in this danger zone for a very long time. The company has already been forced to consider and execute painful reverse stock splits, where they essentially glue shares together to artificially inflate the price just to maintain compliance. But these are cosmetic fixes. They are accounting tricks. They do not solve the fundamental, cancerous problem. The company is burning through cash far, far faster than it is bringing it in. Let's look at the recent trading activity because it's deeply telling. That 2.77% drop on Friday, it happened on very thin volume. This isn't a stock being actively traded by major institutions. It has been abandoned. You will not find significant holdings of BURU in major Fidelity mutual funds or broad Fidelity ETFs. Why? Because the market capitalization is microscopic, the risk is unquantifiable, and the path to profitability is, at this point, purely theoretical. The professionals at firms offering Fidelity wealth management services wouldn't touch this. This stock is now the exclusive domain of high-risk retail speculators and algorithms programmed to scalp fractions of a penny. This is the kind of situation that sophisticated tools on the Interactive Brokers platform are built to analyze, looking at options activity and order flow. But for the average person using the Fidelity mobile app, it just looks like a falling knife. Many people start their online investing journey looking for these exact cheap stocks, believing it's better to own 10,000 shares of something at 25 cents than, say, 2 shares of Apple stock. This is a profound misunderstanding of market capitalization and a cognitive trap that draws new investors into these kinds of precarious situations. The last quarterly earnings report was a confirmation of the market's worst fears. We saw revenues that were essentially stagnant, coming in far below the sparse analyst estimates that even bother to cover it. More importantly, the net loss widened. The operating expenses are still far too high for the revenue being generated. But the most critical line item is cash on hand. This is the company's lifeline, its oxygen. And the burn rate, the speed at which they are spending that cash, suggests they have a very limited runway. They will need to raise more capital, and they will need to do it soon. This brings us to the central crisis for Nuburu. How does a 25-cent company raise capital? It can't issue corporate bonds, its credit rating is non-existent, it can't get a favorable loan from a bank. The only real option on the table is dilution. This means selling more shares, millions more shares at the current depressed market price. This is often called at-the-market or death spiral financing. It is toxic for existing shareholders. Every new share issued at 25 cents makes your 25-cent share represent a smaller and smaller piece of the company. The recent selling pressure we've seen, it is almost certainly the market bracing for this exact event, a massively dilutive financing round that is necessary simply to keep the lights on for another few quarters. And all of this is happening against a challenging macroeconomic backdrop. Even though interest rates have stabilized from their peaks, they remain high. Pre-revenue or low-revenue technology companies, which is what Nuburu actively is, are valued based on promises of future profits. When interest rates are high, those distant future profits are discounted very heavily. Why would a large investment fund risk its capital on Nuburu's 2028 projections when it can get a respectable and safe return from a high-yield savings account or a treasury bond? You can manage those safe assets easily through any Fidelity brokerage account, or even through newer features like Robinhood Cash Management. The competition for capital is intense, and Nuburu is at the very bottom of the food chain. Furthermore, its sector is incredibly competitive. Industrial lasers are not a new field. Nuburu has to compete with established giants like Coherent and IPG Photonics. Companies with deep pockets, diversified product lines, global sales forces, and decades of manufacturing experience. Nuburu's blue laser was its one differentiator, its one shot to carve out a niche in the market. But the market has been painfully slow to adopt it. Manufacturing lines are expensive and disruptive to change. A factory manager isn't going to rip out a perfectly functional infrared laser system for a modest efficiency gain unless the cost savings are massive, immediate, and guaranteed. The expectation of rapid adoption was just that, an expectation. The reality is a long, slow, brutal sales cycle that the company simply doesn't have the cash to endure. So, let's step back for those who are just tuning into this story. What is Nuburu? Founded over a decade ago, the company spent most of its life in private research and development before that 2023 SPAC merger, a vehicle that took many speculative companies public, often far too early. Its entire premise, as we have said, is built on a specific wavelength of light. The technology itself is fascinating. The physics are sound. It has applications in 3D printing with metals, not just welding. The core idea has won industry awards. But this is the hardest lesson in the market. A great idea, or even a great technology, does not automatically make a great investment. This is a truth that many self-investing enthusiasts learn the hard way. You can have the best tech in the world, but if you cannot build it at scale, if you cannot market it effectively, and if you cannot manage your finances, the stock will end up precisely where BURU is today. This is not a stock you would find in SoFi ETFs or be recommended by a SoFi robo-advisor. The SoFi trading platform might allow you to buy it as part of its SoFi active investing options, but it's not the kind of holding that builds long-term security. So, looking forward, what happens from here? For a stock at 25 cents, there are really only 3 plausible scenarios, and 2 of them are terrible. Path 1, the nightmare scenario, is bankruptcy. The company fails to secure new financing, the cash runs out, and it files for Chapter 7 or Chapter 11.